Blake Bos here, folks. Today we're going to be talking about Caterpillar and Joy Global. We're going to be looking at these two companies and see what's really been hurting them, why they've been getting punished by Wall Street. And so what I did here is I compiled two charts for y'all, and what I'm going to do is I'm going to compare growth in inventory and revenue, and then we're going to look at how that relates to inventory turnover. And what is inventory turnover? That's how much a company turns over its inventory balance in a given time period. And what we're going to be looking at here is how much inventory turns over in a year or 12 months. So looking at Caterpillar's chart, we can see that the growth in inventory, that's the green line, has generally red line, has generally outpaced revenue growth. The green line, when revenue is decreasing, inventory has generally decreased at a slower rate as well. And that's exactly what you don't want to happen. You want inventory to pretty much trend in line with revenue growth. And what we've seen with Caterpillar is they've been pretty good at that, but recently they've had some issues. Looking at the period from 2009 until now, you can see the problem Cat has had has stemmed from growing inventory at a faster rate than revenue. And you can also see that the inventory turnover ratio has steadily declined during this period, and that's what's been hurting Caterpillar. That's why right now Caterpillar dealers are working to clear excess inventory and aren't ordering as many new machines from Caterpillar, the company, thereby hurting revenues for the company. So also we're going to look at Joy Global's chart. We can see that revenue growth here, the green line, has generally outpaced inventory growth, the red line, besides the years 2010 and 2011, where you see a huge spike. Joy had some big acquisitions during that time period, which led to higher inventory growth. Also, we can see that Joy's inventory turnover has suffered like Caterpillar's, but has been more consistent over time. So what's the big takeaway here, folks? Well, both of these companies have been hurt by the mining sector slowdown, and both business models have changed over time due to the acquisitions that companies have completed. Caterpillar is now more heavily concentrated in mining, where it appears inventory turnovers are much slower in that industry. You look at a company like Komatsu that competes with Caterpillar and Joy Global, and that inventory turnover ratio is just above 2, just like Caterpillar and Joy Global. So at first look, it appears Caterpillar as a whole could be doing a lot better job managing inventory than we think. It's just that the company has changed over time. It's not the same company it used to be. And so on that point, this is a good step to jump off as an investor. Maybe look at Caterpillar more seriously. Think about it in the way like this isn't the old Caterpillar. Maybe this is a better value, better bargain than I initially thought. So that's what I'll be doing. I encourage you to get on Fool.com, do your own research. Thanks for watching, and Fool on.